lot of wealthy people invest not just in like the stock markets and real estate. They invest in, and why is that?
Like, that is life-changing money. I had one investor reach out to us thinking something was wrong with her bank account because there was so much money in it. And we were like,
I wish that was my problem.
This is actually, that's happening, that's real. The first of which is really just the opportunity for exponential growth. A lot of asset classes will grow steadily over time, and these really have the opportunity to grow at an exponential rate.
Over 30x returns.
A lot of the asset classes of the future are in the...
Today's guest is Trieste Reading. She's an active investor across public and private markets with experience in real estate as well. She first began by investing in early stage startups herself, and now as the VP of growth at FrontFundr, she's focused on democratizing the private markets and giving everyday people access to opportunities that were once reserved only for high net worth individuals. So I'm so happy to have you, Trieste Reading, here, and I'm looking forward to all that we're going to learn today.
Thank you for having me today. I can't wait for our conversation.
A lot of wealthy people invest not just in like the stock markets and real estate. They invest in early stage startups. And why is that?
Yeah, it's a really great question. I think there's really two key kind of appealing things I think that a lot of people see with investing in early stage high growth startups. And the first of which is really just the opportunity for exponential growth. A lot of asset classes will grow steadily over time. Startups and high growth stage companies really have the opportunity to grow at an exponential rate. Of course, with that, there can be a lot of risks associated, but there's higher growth opportunities than you might see in other asset classes or investment domains. So I certainly think that's something that's appealing to a lot of individuals, and particularly those who are higher net worth. They, of course, have disposable income that they're able to put into those different fields. I think the other thing is really, it's quite exciting to become part of a company's story and growth journey and its future. And, for a lot of individuals, investing in companies whose products and services you either want to use in the future or are currently using can be incredibly exciting. It's often a way to, get more products of what we want to see out in the world by supporting them at an early stage so that they can grow. And I think we've seen that over the years with a number of celebrities who have gotten into the space.
Yes.
You've got frequent investors like Ashton Kutcher and Serena Williams who have their own venture funds now, but you also see that with some Canadian examples. For example, Ryan Reynolds, who's founded as well as invested in a number of companies, including, a soccer company, a soccer club, which we've seen in the Canadian market has been made available to everyday investors as well. And, we've even seen Canadian actress Nina Dobrev from The Vampire Diaries, who has invested in Smart Sweets, female-founded low-sugar candy company. So there's a ton of great opportunities to see the potential in these companies, have the opportunity for high growth, but more importantly, become part of their story and, fund companies whose products and services you want to see more of in the world.
Yeah, I love that. So for me, I came across Angel because it's such a gatekept space from like regular everyday people. And I came across Angel investing. It was like 2023. That was the first time I knew about the private market, and there was this whole other world separate from like the actual stock market. It was just at work. So I worked as a tech company. So a lot of people in tech companies invest, and there were people like skip levels, and they had like angel investors in their bios. And I'm like, what's that? I started doing my research. I'm like, oh, okay, there's this other world. I used to like invest in the stock market, and I would say I like taking risks, and I also liked the aspect of like, okay, investing to see potential returns, and also supporting founders and just understanding that entrepreneurs need that capital. A lot of times people have like amazing ideas, but they just need that capital to then actually work on the ideas or turn it into reality. So I actually did my research. I bought like 3 angel investing books because I didn't know anyone around me. I didn't know how to even access it. And coincidentally, like, I found a deal. I don't know how, but I found a deal. And I actually caught my first angel check in 2023 without fully understanding things. And I was like, you know what? I would just like read the book. Well, I had a meeting with the founders team, and then I just ordered the book quickly on Amazon. I read 3 books in the span of like 1 week. I was like, okay, what do I need to know about this? But as I mentioned, like I have a like very high risk tolerance. So I was like, yeah, I'm going to do it. And I just believed in that company. I was like, yeah, this is money I'm willing to like pay to learn. That was my own approach. That's how I take things to things. It's like money to learn, to get my foot in the door and actually understand the space better. So I'm curious about your own story. I know you also have like a story of getting into this space. I'm curious about how that started. What even how did you come across it, and why did you decide, you want to actually like invest in startups?
Yeah, it's a really great question. So it takes me back quite a few years now. I think for myself, it's important to look at, I've always been interested in investing. Like for me, that's something that I've always wanted to learn about. I think learning about and understanding money is so important for anyone across their lifetime. So for me, I've always been interested in that. It was always something that was learned from a young age, even from my mom, saying you need to be investing, X amount of your income with each paycheck that you get. So with that, I've always actively been looking for different outlets to be able to invest. And for myself, actually, when I was studying for my master's, I did a master's of global business where I studied in Canada and then the Netherlands and then Peru. And when I was studying in the Netherlands, I came across some ads for an equity crowdfunding platform there called Seedrs. And it gave you the opportunity to be able to invest in startups. And I looked at that and just thought, how incredibly cool is that I can be like my own dragon on Dragon's Den or my own shark on Shark Tank and really evaluate these businesses and invest in these private companies, early stage startup and growth stage companies, and really kind of be my own dragon. So that for me was quite exciting. As you said, it's a little bit higher risk. You need to have that risk tolerance as part of your investing outlook. And it just for me was really fascinating to be able to kind of put that hat on, evaluate these opportunities strategically and look at which I think have the most growth potential and then back those ones that I'm excited in. But because I was a Canadian studying abroad, I wasn't able to invest in any of the companies that I saw there when I was in the UK. So eventually when I finished my program and came back to Canada, one of the first things I wanted to do is look at, okay, there has to be something in Canada that does this. And that's when I, went to Google and I actually came across FrontFundr at that time. So that would have been, I studied in 2017, came across FrontFundr, and kind of the first opportunity that I had invested in there was a vegan butcher company from Vancouver Island, which had a fantastic brand. They were a newer company. They had products on the market, not a ton of distribution yet, but they were selling out every time they went to a farmer's market. They had a huge social following and customer base. And it was an opportunity listed on FrontFundr that was coming soon. So it wasn't available for investment yet, but it was going to be in the future. So I expressed my interest in that. And when it became available and I started reading more of the investment materials and understanding where the business was at, looking at their metrics, what their future outlook was, I ended up deciding to invest more than I had originally thought. But that was really kind of my first investment that I had made in the private equity space. And not long after that, probably less than 6 months later, FrontFundr actually came up as an investment opportunity. And then I looked at that, and it was so interesting for me to be able to then become an investor in the company that's allowing me to invest in these other opportunities.
I love the flywheel.
I thought, hey, this is going to be great. So I then became a shareholder in FrontFundr. And a while after that, they were actually hiring. So I became an employee at FrontFundr, and I've been with them now for over 6 years. So for me, it's been quite the journey from my first investment in, private equity being through the FrontFundr platform to becoming a shareholder in the platform itself that enables these opportunities to become an employee, and now being here for over 6 years. But yeah, it's been a really great experience. As I've worked at the company, I've continued making investments in different opportunities as they come up as well. And it's something that I really enjoy doing. You get to really understand and know founders, understand what their vision is behind the company, see where the business is at, review their metrics, their, plans for the future, what the market opportunity is, and really just ultimately support these great businesses. And I think that's just so exciting to be able to, walk into a store like Whole Foods and just see a bunch of products on the shelf that I have either directly invested in or that I've helped fund as companies on the platform through FrontFundr. And I think that's just so rewarding and really do take, so much enjoyment out of that.
I love that. I love how you put like your own dragon, basically.
Absolutely.
Because I just remembered I used to love Dragon's Den. So there was actually a Nigerian version. I'm Nigerian. And then I used to watch the Canadian version. Surprisingly, I don't know why I just never got into Shark Tank. And then I watched the UK Dragon's Den version. And I just thought it was only for people like that. I never even tried to research how to actually like invest in these type of startups. I just thought it was only for dragons and you have to be on that level. I just never thought there was like that avenue for other people. So it's interesting that you came across that ad in the Netherlands and you actually took action when you came to Canada. You didn't forget to like actually research and find an equivalent in Canada to invest in.
Yeah, absolutely. It's something that, as I said, just with my interest in my own finances and personal investing, I'm always looking for new avenues. Similar to yourself, I'm always trying to read new books, understand different perspectives, learn about the different asset classes that you can do. And that was one that just kind of stuck with me in terms of, this is really interesting. I want to investigate further. But I do think, to your point, there's not a strong understanding that it is open to everyone.
Yes.
And that's certainly where education and awareness is so important, because, historically, this is an asset class that wouldn't have been available to over 96% of the population, which is huge when you think about it. So, FrontFundr was the first to do this in Canada. We've been making these opportunities available since 2015. And over that time, we've grown the number of companies that are on the platform at a given time. But it's exciting to see these developments take place. And we've seen it across other markets in the world. There's definitely, a lot more work to do on the awareness front. But it is really exciting. And for those investors who, are really interested in that, there's a great opportunity to be able to learn more.
So I know you're an investor yourself. You've also invested in real estate. So just comparing, how would you compare real estate versus like startups? Just your take.
No, it's a really good question. And I think the idea with kind of building your own personal wealth is that you want your money to work for you, right? And you kind of want to be in a position where you're earning money while you sleep. I think both of those asset classes present both opportunities and challenges for that. I think real estate is definitely known for being a very stable option that, although there's no guarantee, generally property values, especially in Canada, go up over time. So that's usually a great option. But the challenge with real estate is really how hard it is to get into that market, right? If you're looking at as an investment property, you need a 20% down payment. Looking at markets across, big metropolitan cities in Canada like Vancouver, Montreal, Toronto, it's very hard to get into. So for myself, I was quite privileged in the fact that I was able to pool money together with my parents to come up with that 20% down payment. So at 25, I got into the real estate market, but wasn't able to get into the market near where I live. So obviously living in British Columbia, in the Lower Mainland outside of Vancouver, prices are quite high. So I ended up doing my research and reading, Canadian Real Estate Wealth magazine and a bunch of other things, and was looking at different markets across the country, and ended up investing in Charlottetown, Prince Edward Island. Completely on the other side of the country. Also sight unseen. We didn't go there to see the property before we buy it. So quite risky there. But it ended up, we could get a triplex. With what we were looking at. So we suddenly had 3 doors, we had 7 bedrooms, and we were able to immediately make some upgrades to that to improve our cash flow situation. So for that, it ended up becoming quite good for us. The first 5 years in particular, the cash flow was quite strong. Then it came time to remortgage, and the interest rates weren't as good. So we were at a point where we were no longer really hitting monthly profitability or break even. So we ended up deciding to sell year 6. But at the end of the day, it was a great investment for us. Over that 6-year time, I made nearly a 4x return on investment.
Good. In 6 years,
If you would look, if I had put the money that I had invested in that into the stock market, growing at 10% over that period of time, I wouldn't have even doubled my money. So it ended up being great for that. But I think there is a misconception with real estate that it's kind of just passive income. And that wasn't really my experience at all, right?
Passive,
being on the other side of the country, we had to hire a property manager. So we were constantly coordinating on, tenant issues, needing repairs for the property. You're always evaluating your bank account. Do we have enough cash in there? Do we need to infuse more capital? There's always all the investment management that you need to do as well. So for me, it wasn't something that I was passively doing. I had to be very actively involved in that investment, but it did generate a good return. I think with startup investing, and particularly with equity crowdfunding, it has a really accessible entry point. And I know we're going to likely get into that a little bit more, but you can start investing with very small amounts to get into these opportunities. And it is something that does have very high growth potential, as we touched on earlier, which can be quite exciting. And it is something, though, that is a little bit more hands-off, which can be something that investors like or don't like. You're putting your capital with this company, and you're going to have no influence on it over the next X amount of years until there's a potential exit event. So you really have to do research on who the management team is and what their objectives are, and make sure that you're comfortable kind of partying with your money over that period of time. But it also is hands off. There's not something that you need to do on a day-to-day or monthly basis to be able to manage that investment, which also is quite appealing. So I certainly think there's benefits and disadvantages to each, and they kind of both have their own strengths and weaknesses. So for myself, I definitely enjoy having both of those as an aspect of my portfolio. But I think for myself, real estate investing is a lot more work than often people make it out to be.
Yes.
But it does have really good return opportunities. And then startup investing is something that can have great returns, but it also is much higher in risk. So you just have to assess what is right for you based on, what you want to build with your own portfolio.
Yeah. Quick one, this podcast is about wealth on your terms. And for a lot of people, that includes real estate. I'm a licensed realtor in Ontario, and I help people think strategically about how real estate fits into their overall wealth plan, whether that be buying, investing, selling, renting, or just making smarter decisions. I'm going to be there to guide you through the numbers, ensure you understand the trade-offs and opportunity costs so you can make informed decisions with confidence. So if you're interested in real estate, check the link in the description box or show notes. And while we're at it, if you're finding value from this podcast, please don't forget to hit the like button and subscribe if you're watching on YouTube. And if you're listening on Spotify or Apple Podcasts, don't forget to hit the follow button and give us a 5-star review. It really goes a long way and it ensures that we're able to put out more episodes for you. And I really appreciate it. Let's get back into the video. I love that. I love how you separated the two of them, because with real estate, like you mentioned, people think things are like black or white, active or passive, but there's a slider to it. Yeah. If you want to be more active, then you can actually control your outcome sometimes in real estate.
Absolutely.
If you buy a property where if you renovate or add value add opportunities, then you can actually increase your growth potential. But like you mentioned with startup, you just drop the money. There's only so much you can do. I've heard of I have founder friends that talk about some angel investors that cut just a small amount of check, maybe 20,000 compared to maybe VC funding. And they're always sending out emails. What's the update and stuff like
absolutely.
that. So it's with startup, you kind of pathways with your money. And there's only so much you can do, especially if you're doing the equity crowdfunding round or angel investing route as well. I think this is quite different. Which brings me to my next question. In the startup space, there's for someone watching who isn't familiar about the startup space, there's venture capital. People have probably heard of VCs. It's actually a space I'm very interested in. And there's angel investing and the equity crowdfunding, which is what your platform does. What's the difference between those three from an investor point of view, or for a regular person's point of view, and maybe from a founder point of view as well?
Yeah, really great question. I think in theory, they're all aiming to accomplish a similar thing, right? It's all different ways of having people invest in startup and early growth stage companies, but who those investors are, how they go about doing that, and what kind of influence they have on the investment, to kind of what we touched on earlier, can be very different. Yeah. So angel investors are really high net worth individuals generally who may be individually writing a check. They're often kind of the first external investors that founders will go to. In many cases as well, there might be angel groups where it's kind of a collective of individuals who get together. Generally, those groups will have a thesis and they'll be presented with different investment opportunities, and they may collectively or individually write some checks together to be able to support those founders. But it's much more an individual looking to back individual founders. Looking at the venture capital level, those are really funds where they're taking, pooled investors' capital to be able to support multiple startups. Mm-hmm. There's inherently a little bit more accountability there because you're accountable to many other investors whose funds that you're managing. But also with venture capital, they often get to dictate the terms of a round, and they might be able to get more of a stake in a company. So often they're more able to influence the actual day-to-day operations and future growth plans of an organization because of the size of check that they're writing. So they'll generally come a little bit after angel rounds, depending on what companies do for their funding life cycle, but they typically come a little bit later when the company's prepared for more growth. And then equity crowdfunding is similarly kind of taking a bunch of individuals to pool capital together to raise a round, but it's a lot of just small everyday investors who can come in and contribute and support a company that they're interested in. So it really gives those everyday individuals access to opportunities that were previously exclusive to high net worth individuals, which is quite exciting. But from the founder standpoint, what can be nice about doing rounds with equity crowdfunding is that founders are really able to set the terms of the round and, not necessarily give up more equity in the company than they're looking to. So it can really be a great avenue for founders to be able to raise capital along different funding life cycles because they're a little bit in more control of what terms that they set. Yeah. And for a lot of those investors, it's really just a chance to come in and support companies that they're passionate about and have an opportunity for a potential future return as well.
So equity crowdfunding basically lowers the barrier to entry for startup investing for the regular investor. investors that aren't like accredited investors or institutional investors.
Absolutely. And it can even be something like we have a number of investors on our platforms who might be part of an angel investing group, for example, but because that group has a very specific thesis, if they want to invest outside of that thesis, or if they want to invest smaller amounts than what those check sizes are, equity crowdfunding can be a nice way to even complement their own portfolio. Because with us, they can determine what they'd like to invest, and they can find investment opportunities that align with their own investment thesis that might be outside that of the groups.
That's true. So for someone listening, equity crowdfunding is democratizing access, but what's the minimum someone can actually put in?
Yeah,
roughly,
absolutely.
and maximum roughly.
Yes, no, great question. So the minimums that we typically see on our platform and what you might see globally on other platforms as well is typically around $250 to $500. It depends on the company. We work, for example, with real estate deals who may have higher minimums, but in general, for startup companies, around $250 to $500. We have had some go as low as $100 per investment, which is great. But it's very accessible, and that's really the nature of what equity crowdfunding is. It is trying to make it accessible to as many people as possible. So having those lower entry points are a great avenue for that. We do also have a number of companies that will offer a little perk with the investment as well. So you get equity in the company, but also maybe some of the products that they offer as well. And in that case, they might structure some different tiers. So although $250 is the minimum, if you invest $1,000, maybe you'll get some extra product perks along with the equity in the company, which is quite nice. But the maximums is a great question. So in Canada, there's 3 different types of investors that are recognized. So one is retail investors, one is eligible investors, and the other is accredited investors. So there's several different criteria that go into how you classify those groups based on income, financial assets, other things like that. But at a very basic level, if you just look at income, retail investors generally earn less than $75K per year. Eligible investors are generally $75 to $200, and then accredited investors are usually over $200K or more. So that's just very basic level, much more criteria there. But as you're looking at that, under the startup crowdfunding exemption, which is the main way that companies will raise capital in Canada, retail investors can invest up to $10,000 if deemed suitable by a dealing representative. So that's something that we're able to do as an exempt market dealer at FrontFundr, or if they're deemed unsuitable, they can invest up to $2,500. So that'll be something in the investment process, and we can touch on that a bit more later. But if you're an accredited investor, there is no limit to how much you can invest, which is nice. The other exemption that Canadian companies often use to raise capital is called the offering memorandum. So with that, it actually changes the investment amounts a little bit. So if you're a retail investor, you're still held to that 10K limit. But if you're an eligible investor, it's generally 30K to 100K if deemed suitable by a dealer. If you're an accredited, you still have no limit. That's nothing to worry about. But what's interesting there is that one is actually a little bit different at the provincial level. So the crowdfunding exemption, which I talked about earlier, actually created a harmonized rule or legislation in 2021 where it would be the same limits across the entirety of the country. The OM is still a little bit different. So if you're a retail investor in BC or Newfoundland and Labrador or the territories, there actually is no investment limits. So you can be a retail investor in BC investing with really no limits
Ontario
under the offering memorandum. Yes, so it's really interesting to see those different rules, and that can be a little complicated to understand. But the nice part is both as a founder and as an investor through a platform like ours, we're able to just easily go through that process, let everyone know what their investment maximums are as they go through. And for founders as well, we help clarify all of that. But yeah, in general, most of our companies will raise under the startup crowdfunding exemption, which has that 10K maximum if deemed suitable.
Oh, that's perfect. And it's good that FrontFundr, like a platform like FrontFundr, handles all of that.
Absolutely.
It's like you just know whether you can invest or what the max is that you can invest in, and that's it. But it's interesting to know that in Canada, things aren't like at a global level. It's more like local level and legislations.
Yes, a lot of it is still at the provincial level. There's different provincial regulators, not national regulators. So there are a lot of nuances there to still understand, which is where platforms like ours can help the founders understand that and also help investors understand that a little bit more, but can be quite frustrating. I think in some other more mature markets in the world, that's a little bit different now. But in Canada, it's still often very much at the provincial level.
Yeah, good to know. When it comes to like startup investing, we talk about the sexiness. Everyone hears about Figma, for example, or even Uber. If you had invested years ago, this is how much people have made now and stuff like that. So for people who are listening and don't understand, you actually make money if the company exits. There are times where unfortunately, your money goes to zero, basically. So, for example, like putting it with the stock market, in the stock markets, you make money when you sell at a higher price, and that's when you recoup your money back. And in the startup world, there are like two major ways company exits. One is maybe a bigger company acquires them through acquisition, and the other is if they IPO. So they then list their stock on the stock exchange or their company on the stock exchange. So I know FrontFundr has like had multiple exits. You've also had an exit yourself. How was that process for you personally? If you don't mind sharing, I just want to talk about like the returns, if you don't mind sharing.
Absolutely. I think to your point, startup investing can be seen as very, exciting. You certainly hear in the news of those opportunities where early investors have been able to have a substantial exit. I think
like
if you
1,000x.
Oh, absolutely. Even at a minimum, like looking at tech companies like Airbnb, Zoom, any of those that you're able to get in early on, you're likely looking at a minimum of 50x return in a couple years, which is just exceptional. But to your point, that's not always the case. I think it's important for people to understand that ultimately the generally recognized statistic is that really 90% of startups fail. So for every one that might have an exceptional return, maybe there's 20 that didn't. So that's really important to understand. I think for myself and my own investing journey, I definitely hit a bit of an outlier in terms of performance for a company that had an exit. First company that I invested in on FrontFundr was the very good kind of meat company that I had mentioned. And I invested in 2018, I believe, and they IPO'd in 2020, which...
So that's like how many...
It's incredibly quick,
3 years,
right? Normally when you're looking at startup investing, 5 to 10 years, exactly. And this was 2 years. And there had been a huge boom in like the vegan food industry. Beyond Meat had just gone public, things like that. So they ended up becoming like the largest or best performing IPO that year, which was exceptional. They listed on the CSE first, and they went to the TSX, then they went to the NASDAQ. And it ended up being, for me, I'd invested actually under a convertible note, which converted prior to them going public at around 12 cents a share.
12 cents a share.
They publicly listed at 40 cents a share. So you're automatically looking at a gain there if you would have sold right away. And their stock ended up hitting a height of, I think it was $9.85. Which is just absolutely incredible. And for those who sold at the height of that, like that is life-changing money. We actually, as a team at FrontFundr, had one investor reach out to us thinking something was wrong with her bank account because there was so much money in it. And we were like,
I wish that was my problem.
This is actually, that's happening. That's real, right? So being able to see that was amazing. And for myself, I didn't sell at the height. I still made out great, had a really good return on investment, but didn't sell at that height. And I think that's a very important thing for people to look at is, once you're dealing with private companies, there is no management of the investment. It's just things are happening in the background. When they go public, you do need to stay pretty up to date on things happening with the company, day-to-day operations, and you need to know when to exit. And sometimes I think with public market investing, knowing when to exit is sometimes almost more important than knowing when to enter. Like it's really, and it's not often talked about enough. So I think for me, that was something that I definitely learned is that you want to be really attuned to that. You want to be watching it closely and you want to know exactly what kind of your strike price is going to be to get out of the investment as well. But it was an amazing opportunity. And for investors on our platform, like it's just the most incredible outcome you could have asked for. But like we kind of talked about, that's not always the case. So recently, this past year in 2024, we did a community capital report where we looked at kind of our portfolio of funded companies in the history since we've been doing these investments since 2015. And really 87% of companies were still active. 13% had dissolved, which is pretty good. But of those who are still active, around 14 had exits. About 2/3 of those were public market exits. So TSX, CSE, whatever it might be, which is great for providing liquidity to investors. As you mentioned, there's a few avenues typically for that. It's usually acquisition or it's listing publicly on the stock exchange. So that was really great to see. And in the year of 2024, we had a few different examples actually of what that looked like for exits for FrontFundr investors. One, we had a company called Hempalta that went public on the TSX. If you had sold at the height, that provided, I believe it was around 126% return for investors, which was pretty incredible.
Good,
But again, you got to know when to sell. That's the thing. So the tough part.
I feel like with the private market space, sometimes it feels like a lot of things is like making bets. And sometimes your bets aren't, even top VCs sometimes make bad bets. So when it comes to like when to exit, are there like frameworks you use or you've seen people use or just like tips?
Yeah, it's a
going
great
to sell?
question. I think a big thing is just really staying informed and up to date on companies and what their earnings reports are, and trying to learn and understand how to actually read those is definitely an important one. And you know, what is the company actually telling me? I think what can be interesting is a lot of companies, when they go from being private to public, a lot of those early investors sell off right away. So oftentimes stock actually dips early and then it starts to pick back up over time. So if you're coming from a private to a public opportunity, you really need to figure out what approach you want to take. Do you sell right away, or do you try and hold this longer term to see if it'll go up over time? But there will likely be that dip. So understanding a bit of that is definitely important. And I would say there are a lot of investors out there who offer great resources on kind of understanding how to read public documents that companies will make available, and learning to understand that yourself can be really good, so that you're not being overly persuaded by emotions or what other investors might be doing. You're trying to understand the basics of this business, and are they still in a good position to be able to pursue growth in the future, and really understanding things like that. So I think that's where kind of reviewing your portfolio and watching your investments becomes a bit more work. And so it's definitely important to stay up to date on that.
I love that. I find that some people are skeptical about equity crowdfunding. So it's good to hear success stories, because with your case, that's, if I'm doing my math well correctly, that's like over 30x returns. Yeah, that's an outlier for sure, but it's over 30x returns. And it's so crazy that someone had to call to say, like, there's something going on with my bank account. I wish that would be my problem, because that's an amazing problem to have. So sometimes people feel like, people really rate companies that are VC backed. They feel like, oh yeah, these are the top tier companies. They're definitely going to succeed. And then they feel like maybe companies that then come through equity crowdfunding are companies that are just like remains of VC, like companies that VCs didn't want to back, basically, or angels didn't want to back. What do you say to that?
Yeah, I think that's a very common misconception. And I think there are two key themes I'd like to get into there. One is that we actually do work with a lot of companies that are VC and angel backed. And it can be a great way to complement a larger funding round. And the benefits that equity crowdfunding can provide for a lot of these companies is really validating product market fit, as well as actually building a customer base. And those are things that you can't necessarily get out of a VC or an angel writing a check, but that you can with equity crowdfunding. Equity crowdfunding can really become a branding and marketing exercise for companies. Investors can become customers, customers can become investors, and you can really raise capital while increasing your revenue at the same time. So there's some great benefits there. The other key thing I think to look at is that really only, I think the numbers are like 0.5% to 1% of all companies ever get VC backing. So if you're looking at that, out of 100 companies, 99 are never going to receive VC funding. So I don't think we should look at that as, oh, VCs are, just passing on these opportunities. It means that they're not good. There can be amazing businesses that just may not be a sector fit, for example. Like VCs may be focusing more on tech because that's where the larger returns live. So they may be less likely to fund CPG companies, for example. So that's always a consideration to look at. The other thing is that minority founders often don't get the same level of VC support. If you're a female founder, if you're a founder of color, if you're a founder of the LGBTQ community, you might not be getting into those rooms or getting the same opportunities that a lot of historically white male founders get. So that's always something too. And, these founders are no less qualified or able to build great businesses. They just may not have the same opportunities presented to them. So equity crowdfunding really gives all founders the opportunity to raise capital from their communities. And I kind of like to say it's really an opportunity for you to build your own table and invite whoever you want to it, which is really great. And I think if we even look at studies, I think it's BCG's done a study where female founders, for example, were able to generate 78 cents of revenue per dollar invested in the company, whereas male-founded companies only generated 31 cents in revenue per dollar invested.
Most of the funding.
They get most
only
of the funding.
I think 3% or 2% of VC funding goes to female founders.
Exactly. So if you're looking at that, their VC funding shouldn't just be an indicator of a good business. There are so many amazing businesses out there who maybe VC funding doesn't even make sense for their journey, or who may not be able to get into those rooms. So I think it's always important to not use that as a validation tool, but really assess these businesses yourself, review their opportunity, review the founders, what are their growth plans, and make that decision for yourself without relying on VC as like a stamp of approval.
I love that. I love that take. So I know I really wanted to talk about the sexiness of startup investing, just because, as you mentioned, there's that lack of awareness problem. And with a lot of people, with the awareness, it has to be the sexiness first before the risk and the downside. So now let's talk about the risk of startup investing. There are cases where people actually lose 100% of their money. So would you say there's a category of people that maybe startup investing isn't just for?
Absolutely.
Yeah.
I think there are a few key factors with startup investing. The first being, which we already touched on, is that like 90% of startups fail.
Yes.
I think there's even a study from Harvard Business Review where 75% of venture-backed companies don't generate a return on investment at the end of the day. So that's quite a few companies, right? There's a very, very high risk. There's a chance the company will perhaps not have enough money to scale or not be able to find their place in the market, and that the company could ultimately fail. The other thing to consider is that these opportunities are illiquid until there's an exit event. So for people who are familiar with public stock investing, you can buy and trade stocks anytime you want. There are a lot of people who really during 2020, 2021 really tried to get into day trading. Not a domain that I'm particularly good at myself. But a lot of people were. So if you come into private market or startup investing with that mentality, it's not going to work for you. This is something that you are looking to hold for 5, 10 years potentially before you might see a return on investment, if a return on investment is ever there.
I love how you said might.
Yes, absolutely. So you really have to qualify that. There's a chance that, you may never receive a return on investment, and it may take many years before you do. The other thing I would recommend considering is that if you are familiar with investing in public companies, there are certain requirements that they have to make in terms of what they communicate to investors, right? So you'll be looking at quarterly reports, annual reports. There's a lot of disclosures and transparency that they have to have. The private markets are less regulated in that space. So we encourage every company on our platform to be sending quarterly updates. There's no guarantee that they do. We try and chase companies down as much as we can to get those communications out. But with private companies, they're generally smaller, very small teams. They don't have investor relations departments to be able to put together these press releases that go out all the time or publish these big annual reports. So you might see less communication about your investment. So I know you mentioned earlier angel investors trying to write these companies, right, to get an update. And if you're an angel investor who wrote like a $250K check, the founder's going to get back to you. But if you put in $250, they're probably not too concerned about responding. They should be. But there is a chance that you might not receive the level of communication or updates about your investment that you would like. So I think it is important when you're looking at these opportunities to look for companies and founders that are being very transparent, that are communicating a lot, that do seem like those who are going to be quite trustworthy. But there are some key factors. Many startups fail. The timeline for a potential exit and having the ability to sell or see a return is very long term, could be 5, 10 years. Of course, could be quicker, but that's what we recommend on average. And then there is a chance that you won't receive the level of communication or updates about your investment that you're looking for.
I like that because personally, I invested like 4 figures in that company. I've gotten a few quarterly updates, but not as frequent as my regular like public stock market quarterly updates.
Absolutely. And I feel like sometimes too, it could be like you get an update in Q1 and you may not get another one until Q4. And it's like, okay, what happened to the consistency of every quarter? But sometimes these founders are just far too occupied that they don't have the resources. That's best case scenario. Worst case scenario is that they may not be managing their business super well.
I've been like following
But it can absolutely be difficult. So that's why for us as a platform, we're very mindful of that. And we do try and work with these companies to ourselves, be following up with them and receiving updates so we can pass that along to investors. But those are definitely, like, if you're not comfortable with that level of ambiguity and not being able to sell your investment right away and having that level of risk, then, maybe you want to dip your toes in the water with $250, but it's probably not somewhere that you want to consider allocating too much of your portfolio towards, just knowing that it's not going to act and behave in the same way that a public market investment would.
I love that. I love that take. And you alluded to this also with like diversification. And I know in the startup space, at least there's this rule of thumb that you should put maybe like 5 to 10%. I know some people stretch it to 20%. And even the VC world, like you alluded to, there's this like power law they say, where it's like they invest in maybe 20 companies and they need 2 to outperform so they can return the investment back, like the money back to the investors they collected money from. So what's your take in terms of like diversification? What is your own personal take in terms of like how you split things up and diversification when it comes to like different asset classes?
Yeah, it's a really great question. I think we see in general, kind of to your point, the recommendations are really no more than 10% of your portfolio into like high risk private equity is a general accepted guideline. So I think that's something important to keep in mind. I think, as you mentioned too, with actually creating a portfolio, that's another consideration. Like, depending on how much disposable income you have and what you're looking to invest, you can go and write a single check for $10,000 and, hope that one company turns into something in the future. Or you could invest in 10 to 20 companies, at kind of that $250 level and really build a portfolio and hope that one or two might have an outsized return that'll help your portfolio see a return at the end of the day. So it really depends on what investors are comfortable with. For myself, I've had some that are a little bit higher in investment size, some that are a little bit lower. I think it's important to understand what types of businesses you want to invest in as well as part of your portfolio. So I think that's a good consideration for people. I think in general, what we're seeing as well is a bit more focus now on the private markets, which is interesting. There is more raised awareness of it. More people are talking about it. So in the CEO of BlackRock, Larry Fink's I think it was his 2025 investor letter, he was touching on the fact that a lot of the asset classes of the future are in the private markets. And that can be things like ports, data centers, some of the fastest growing private companies, and they're typically hidden behind pretty big walls. So one of their focus areas is to help democratize some of that as well. And they're actually, I think, investing $28 billion in trying to make these opportunities more accessible for investors in the future, which is great. But of that, he's advocating for around 20% being invested in asset classes in private equity, like infrastructure and real estate, as well as private equity. So fast growing companies. So that is something for investors to consider. I think it's just, important to understand, if you are going to build a portfolio, what does that makeup look like? What types of opportunities do you want to invest in? And then, it can be actually great to do a number of small investments that have an opportunity versus one big one, but it depends on your own kind of investing objectives as well.
I like that, because personally, I would rather like split it around. My first one for me was just learning, paying to learn. I didn't mind because I had a lot of disposable income. But just talking about evaluating startups in real estate space, a lot of real estate investors evaluate based on cash flow, cap rates, stock markets, price to earning ratio, growth of the company, all of that. Startup is such, as you mentioned, because things are not fully set up and the founders are in that building stage, it's such a difficult space to evaluate. And I feel like the experts, who I'll just mention here as VCs, have their own system. Sometimes they use the moats of the business. Sometimes it's even based on the founder. Did this founder go to Stanford? Sometimes it's where did these founders go? Do they have the network and all of that? So for a regular investor, an everyday investor that doesn't have that expertise, how should they evaluate startup opportunities? I know you've alluded to a few things there, but what's your take on that?
Yeah, that's a really great question. I think at a very simple level, it's always a great principle to invest in what you know, right? So looking at businesses that have products and services that you either use or would like to use or just understand in general is a great place to start, especially as you're new into the space and trying to understand this a little bit more. I think where a lot of people can get caught up with things when investing is really when they fall into hype on things that they don't understand. And that's when it can be kind of a bit of more of a gambling or dangerous space to get into, right? So making sure that you understand the business is principle one. As you're looking at these opportunities, though, there's a lot of different things. I still think evaluating the founders are a great approach, right? How you do that, though, and what information is available to you might be a little bit different. You might not be able to meet the founder for a coffee and grill them for 15 minutes on questions, but we do tend to make campaign videos available as part of the process, so you can learn from the founders, their mission and vision. You can also see, what their professional backgrounds have been like. Have they had companies before? Have those companies had, successful exits? Do they seem like they're going to be good stewards of my capital? Are they being transparent? Are they communicating frequently? Those are all really great things to be looking to. I think the other thing is really just, understanding, hey, where do these companies want to head? Right? What's the ultimate end goal? How are they going to go there? Understanding the market is very important. What market opportunity actually exists? do they have their own unique way of getting there? So I think moats might be a little bit less definable at that stage, but understanding, are they actually uniquely positioned, and do they seem to have something that could be a long-term durable competitive advantage is still important to look at. And then really understanding, within the specific round, how are they using the funds? How do they plan to grow? Do I see a possible exit for this in the future?
True,
Can I imagine it? So I think those are all important things to look at, and really doing your own due diligence. For myself, who came from more of like a marketing background, I also like to just look at, what is the brand of the company? Does the brand have inherent value tied to it? Because, they've created something that's recognizable, something that customers really identify with, something that can grow. So I think you always bring a little bit of your own unique experience into assessing the opportunities as well. And then as you grow, and if you get into this more, I think what then is important is to actually define a little bit more of maybe what your investment thesis is. So what are the types of opportunities that you want to look at? What do you understand? And actually a book that I read that I feel like does a good way of shaping this for beginner investors is Invested by Phil and Danielle Town. So talks about investing in companies, and they recommend creating a Venn diagram with 3 circles to determine your investment thesis. One is kind of where I spend my money, one is how I make my money, and one is what I'm passionate about. Kind of the intersection of those 3 circles becomes your investment thesis, or can help define the industries, the sectors, the types of companies that you should be looking at. So that can help filter out, I don't understand this space too well, maybe I shouldn't get into that. But of course, if you're willing to educate yourself on that, it can be fine. But that can help just shape what opportunities you look for. And then from there, you can really dive into the details of, what is this company like? What is this founder like? What do I see here as the opportunity?
I love that. I'm going to take a look at that book, because I've been struggling. I was actually going to ask about investment thesis, because more seasoned investors have investment thesis. There's some funds, like you mentioned, why some people in angel network groups might even come to equity crowdfunding is because their investment thesis invest in only a particular industry or a particular stage or type of like founder or stuff like that. So it's good to develop your own investment thesis. And I've been struggling with that. I've just been investing in companies I understand, because I have that
great way to start, right?
Tech knowledge. So it's only tech companies I've been investing in, because that's what I understand. But I've been trying to actually form my own investment thesis. So I'll actually take a look at that book.
Yeah, I would definitely recommend it. But I think definitely at a basic level, investing in what you understand is key. And I think a lot of people see that. They'll invest in that. I know for myself as well, being in the tech space also, that's a high concentration of my portfolio, just because you understand it, you know how to see that opportunity. But getting back to like the earlier point of diversification, that's also important. So how can you leverage those skills and your understanding, but apply that to other sectors can be interesting too, because then you're also diversifying your portfolio a little bit more. So not that tech is really ever down, but if tech were down, you've got investments in other sectors as well that might still have opportunities at high growth.
Yeah. And I love how you pulled your marketing experience into it, because at the end of the day, a platform I feel like these days, it's really whoever has distribution or the best distribution that makes it. So you might have the back end, maybe they just don't know how to get to consumers if they're a B2C company. But with that marketing experience or background, you can see if, okay, this company is positioned in a way where they'll be able to get distribution, put awareness out there and stuff like that. So that's very interesting, like bringing your own flavor.
Yeah.
Some people might be like, oh yeah, I'm in marketing. I might not like know how to gauge startup opportunities. I'm not in Silicon Valley and stuff like that, but it's like we all have like unique things that we can bring into the table.
Yeah, and it really helps investors who are just getting started to leverage their own experience. Like let's say you're looking at someone who's a doctor, for example, who might not want to get into investing or be too experienced for it, but they'd probably be great at evaluating different tech companies that are focused in the med space and really into med tech, and being able to review those opportunities, because they're like, I've seen the need for this in the market. I understand that it's there. I know what they're talking about in terms of their scientific research. I understand that. So just because you may not have a background in finance or in tech doesn't mean that your experience from your profession isn't going to be helpful in evaluating investment opportunities. So everyone should always bring that learning and, decades of experience that they might have developed into their career, into, how they evaluate opportunities as well.
That's true. My next question is really about where I was just talking about this with you. So a subscriber left a comment about this UK scheme called SCIS and EIS. And from my understanding, basically the UK government supports investors or encourages people to invest because they have this loss relief program and tax relief system. And then even with the capital gains, I think it's at a reduced tax rate or something like that. Anyway, it just like encourages people to invest because with startups, as we've mentioned, you can actually absolutely lose your money. It can go to zero. And at least they have that, it reduces the risk for some of the investors. They were like, is there something like that in Canada? Do we have systems like that in Canada?
Yeah, so that's a great question. And I think when looking at the different markets, equity crowdfunding, there are a lot of markets developing. The UK was really the first to get into the space and to start doing this. So they're a very mature market. As well as that, a lot of early stage funding moves through equity crowdfunding platforms. I think a statistic from a couple of years ago was that really 40% of all early stage funding was going through these platforms. So they've really created a lot of legislation and policies that really encourage this, both from a founder and an investor standpoint. Canada's a little bit behind that. Our market started a few years later. It's still a little bit younger, and it is, as we kind of touched on earlier, oftentimes there are nuances at a provincial level rather than a national level. So to answer your question, yes, we do have some tax credits that are available incentives to investors. So we have something called EBC in British Columbia, the Eligible Business Corporation Tax Credit, and that's a 30% tax credit for investors. So if the province applies or the company applies to be an eligible business corporation, and the investors from BC, they can participate in that 30% tax credit. Some of the other provinces also have those. I think Saskatchewan has one for 45%. I think there's one in Prince Edward Island possibly as well for 45%, but it is different at the provincial level.
Oh, I see.
And it's not necessarily standardized across Canada. I think those incentives can also be better. So that is where, you really do want to see the government encouraging innovation at an early stage, both for founders and investors. So we don't necessarily have anything pertaining to like loss or being able to have any claims on that, but we do have some tax advantages that can be made available. But certainly I would say there's more work to do in Canada to get to the level of other markets like the UK, where it is a lot more mainstream and there are a lot of additional benefits for investors there.
Yeah. And speaking about like at least TFSA, RRSP, are there ways where you could invest in, you can use your TFSA, at least so it's tax sheltered? Because imagine like getting a 40x return and then you have to pay 50% capital gains tax or so. I know real estate, there are ways people can reduce their tax, lower their tax. Then with the public markets, if you put in TFSA sheltered accounts, there's that. But with private markets, is there something like that?
Yeah, so that's also a really good question. And the answer is yes, there are opportunities for that, but it is a little bit nuanced. So we do work with some companies who will make the investment opportunity available for RRSP and TFSA, which is great. Generally, though, it'll be at a slightly higher minimum investment. So if you're looking at an entry point of $250, let's say, maybe the RRSP TFSA doesn't start until $2,500. And the reason generally for that is that you can't invest through your RRSP and TFSA at like the big banks. I can't use my RBC RRSP to be able to invest in private startups. But we do work with some great trust companies across Canada, including like Western Pacific Trust Company and Olympia Trust, who will help make these opportunities available. But there are account opening fees. There are yearly account fees. So you don't really want to be paying that on a $250 investment. But if your investment is higher, definitely it's a great avenue to pursue. And to your point, then that does help, if you're in your TFSA and you do see a return like that, that's a great benefit. As well as your RRSP, if you're wanting to make that towards kind of your annual tax amount, so you can, lower your income based on that. So there are some great advantages to that. It is just considering that, generally slightly higher minimums because you want the cost of the account operating to essentially be worthwhile for your investment. Yeah. And then the other thing is like, if these companies do go on to an exit and you haven't invested through a TFSA yet, you essentially at that point of exit get like a DRS where you're able to take that to a brokerage and then you're able to start trading that through your platform. So at that time, you could move it into something like a TFSA, but there could be at a point where there's already been some gain on that investment and things like that. But there is the opportunity to move it in the future as well at that point of exit if they're listing on the stock exchange.
Quick pause before we jump back into the episode. This podcast is about building wealth on your terms, and for a lot of people that includes real estate. So if you're interested in real estate and want to connect, check the link in the description box or show notes. If you find this podcast valuable and you're watching on YouTube, please hit the like button and subscribe button. And if you're listening on Spotify or Apple Podcasts, please give us a follow and leave a 5-star review for us. That's good. I'm sure there are a lot of people listening now and they're like, okay, how do I make that move? Now there's like this equity crowdfunding platform. They might not know about FrontFundr. What's the process like?
Yeah, it's a great question, right? Like, where do you even start?
Yeah.
So I think generally there's kind of two ways to look at it. One is you might find a startup that you like who is raising and you're kind of brought to the platform through there. The other might be like me, you're looking for the platform to give you these opportunities.
I think most people will be in that case because I feel it's gate capped. It's like
yes,
the deal flow just flows to three people who are they already know have high net worth or have the money.
Absolutely. So yeah, I think when you're looking at the platform in Canada, there's two big considerations. One is that you could come across a platform that's more of just a listing portal versus an exempt market dealer. So a listing portal is more of an advertising platform where they're not necessarily performing due diligence. And generally, if you're a retail investor, you can only invest a maximum of $2,500 because they don't actually perform suitability. So those are some considerations to keep in mind. FrontFundr being an exempt market dealer, we perform due diligence on every opportunity on the platforms. We like to say that we're a curated marketplace because we actually vet the opportunities. And of the companies that apply to raise with us, generally it's less than 10% that actually list on the platform.
Okay. So you do serious vetting. You have analysts
we
and
do
all
vetting,
that.
absolutely. So
that's good to know.
That's something to consider. And the other thing is, as an exempt market dealer, we also perform suitability. So that's where we're evaluating the investment that comes through based on, the profile of the company itself. And if we deem that investment suitable, you can invest up to that full 10K amount. So you're really leveraging the full potential of the exemption that you can't do on a listing portal. So, around the world, there are different equity crowdfunding platforms. We've already touched on kind of Seedrs in the UK. There's Crowdcube there as well. There's Republic and Start Engine in the US. And those are all registered platforms that are vetting these opportunities and providing that suitability. So I'd start by looking at that platform and which one aligns with the needs of what you're looking for. From there, it's really diving into the opportunities, understanding what you want to invest in, looking at these companies. And if you are using that registered platform, there's going to be a basic set of information that companies are making available. Generally, it's a video introducing people to the company. There's a full investment information walking through things that we touched on earlier, like the problem and solution and market opportunity and use of funds and potential exit strategies. There's a full offering document to review that walks through the business, their management teams, risk associated with the investment, things like that. Generally, we make an investment presentation available. So really, those resources are all at your disposal to be able to review and evaluate the opportunity. Once you've made that decision to invest, you're going to start going through the process. And it is a very streamlined process. You can complete it with us in a couple minutes going through it.
Good,
it's fully online, which is great. A couple things to consider, though. As an exempt market dealer, we do need to perform ID verification. We want to make sure you're a real human. That's an important part of it. And we also do perform that suitability. So will ask some financial profile questions, things like that. What is your time horizon? If you tell us you want to return this year, but your time horizon's 10 years, that's going to be a bit of a disconnect. So we're looking at things like that to be able to perform that suitability. You're then able to sign the investment documents right in the portal and make payment. And what's great about the payment method is, I believe it was 2 years ago, now we introduced credit cards. So it's super streamlined. We have a ton of payment methods available. You can e-transfer, pay via credit card. We also have, wire transfer and things like that for larger payments. But it's a really convenient process. So you can go through in a single session and from start to finish complete your investment. And then you'll be able to see it, in your portfolio on FrontFundr that you've made this investment. And then after that, it comes down to, what kind of communications that I'm going to receive afterwards. So we definitely encourage companies to use the FrontFundr portal to continue sending those communications. If not, looking out for quarterly emails and stuff like that. But I think what's so great about what Equity Crowdfunding has done is not just that it's made it accessible, but it also really has digitize the investment process. If you're looking historically at venture capital and angel investing, it is a lot of manual back and forth, a lot of just sending documents via email, signing with lawyers. And it can actually be a pretty complicated or intimidating process for a lot of people. So particularly for smaller investors to be able to come through and complete everything online and go through in a single session and have the documents there, be able to make your payment all on the platform, it's a really seamless experience that I feel like helps make the process a little bit less intimidating as well.
I agree. Even just the first step of deal flow, some people might be like, oh yeah, I'm interested in startups. Where do I find startups?
100%.
The only founders I know are my friends, and I don't even trust their startups are going to make returns and stuff like that.
Absolutely.
So deal flow is already gate capped. People feel like, at least in tech, Silicon Valley has the best deal flow, stuff like that. That's what people feel. So at least your platform is doing all of that. And then for people who don't have that financial knowledge, you're doing the due diligence for them. People might end up investing in like startups that they just shouldn't have invested in the first place. So at least there's that protection that your company is doing, at least at the base level, to help people. So there's so many steps that like FrontFundr is doing that just makes it easier and just improves access for other people.
Absolutely. And it's so important to still do your own due diligence. Yes. But yeah, to your point, like we do vet all of these companies. We do look at their backgrounds. We do look at, all the documentation related to the company. And if for whatever reason we see something that we think is a flag, right, we're not going to list the company on our platform. So it's a very important part of our process. And it's certainly something that makes us different from a listing portal, which really is an advertising agent. And what are these founders doing behind the scenes? Are they going to be good stewards of my capital? Yes. That might be a little harder to identify. So that is a great added benefit. But certainly always do your own due diligence on the opportunities as well.
Because a regular person might not know what to even look out for. Absolutely. When they're doing their own initial vetting of the founder, they might just not know what to ask, or what questions to ask, or what to look out for. I remember my first meeting with the founder. I was like, what questions do I ask? What do I actually look out for?
ChatGPT, what can I ask this founder?
It was 2023 because there was ChatGPT at that time. and that's why I brought 3 different books. Yes. And I'm like, okay, well, let me just scan out 3 books and know what to ask.
Yeah, absolutely. And I think what is good to know as well is, there are avenues to also be able to ask these founders questions, even through our platform. We do have a Q&A where you can reach out to the companies directly with what questions you have. Yeah. We also often host founder pitch sessions where you can ask founders questions live, or sometimes even just reaching out directly to the team. Particularly if you're going to be writing a fairly significant check, it is nice to be able to meet the team one-on-one and ask them questions. Right. So those are opportunities that are made available to investors as well. So you can try, and if you do have those extra questions, you can try and get them in front of the founders as well.
What's one tip you give to someone who's like, okay, I think I'm going to actually download this platform, actually look into it and start looking at the available opportunities? What's one simple tip you just give them?
Yeah, it's a really good question. I think at a basic level, don't invest more than you're willing to lose, I think is always the biggest piece of advice with any investing. It's something that I had a professor in university who was a venture capitalist, and that was kind of the leading principle there. I think, if you're looking at how much you should invest in the company, and if 10K is going to hurt you, don't invest that 10K. Invest amount you're comfortable with parting with. You might not see that for many years. Yes. You might never see it again. So you have to be comfortable with that. And then I think it really comes down to just investing what you know, which we talked about earlier. That's really a great philosophy there. But I think at the end of the day, something to think about with this form of investing is, in my opinion, just how great it is to be able to support Canadian companies and Canadian innovation. Especially right now with the Buy Canadian movement, it's not just Buy Canadian, it's Invest Canadian, right? And we vote with our dollars every day. Yeah. And small and medium-sized, growing businesses are, so grateful that they have support from the communities to be able to grow their businesses. So if you're already thinking about investing, why not look at the great Canadian companies that we already have from coast to coast to coast? And platforms like FrontFundr give you that opportunity, which is awesome.
Right. Speaking about that from the founder's perspective, what type of founders or what type of companies do you have on the platform? I know you said even real estate companies as well, tech companies. And then what type of founders should actually think or consider crowdfunding?
Yeah, absolutely. So I think at its most basic level, we like to say that we're industry agnostic. We really do work with companies across industries. That being said, sectors that tend to perform best, often tech, fintech in particular, CPG because they are consumer-focused companies, social impact because people really identify with the company's mission, as well as real estate. Real estate is always a big area for us. So from a raise standpoint, we typically work with companies looking to raise anywhere from $250,000 to $10 million plus. Real estate deals can often be bigger than that, but that typically is the range there. And then we do work with companies really from pre-seed, seed to Series A, all the way to pre-IPO rounds where companies need distribution and to increase their shareholder count before they go public. So we really do work across stages, though we will see more kind of pre-seed and seed stage companies. So if you're a founder who kind of meets that criteria, it's a great opportunity. The biggest factor, though, that I will say is that we want to look for companies that have a community. So we often like to call equity crowdfunding community capital. You're really at that point becoming powered by the community, which is very exciting. So what tends to perform best are companies that have an existing community already that they can tap into. So that's a very important factor for us when looking at what companies to work with, because we want those companies to have the best chance of success. So it's really important to either have that community or try and build that community ahead of this form of funding to be successful, and to not just build the community for sake of building the community, but to authentically, engage with and really create a meaningful community is really the best way to ensure you're going to have success with this form of funding in the future, but also just success as a business. Because if you have that strong community, it's going to do wonders for you, both from an investment and funding standpoint, but also from a revenue standpoint.
That brings me to my next question. Blossom Social recently broke the Canadian equity crowdfunding record
Yes.
with a $1.93 million raise in under 6 hours. Do you know how many founders are stressing with VC meetings, angel meetings to just raise So it's what can founders do to set themselves up for that kind of success? I know you just alluded to the community aspect, but
I think Blossom is the gold standard for a successful crowdfunding campaign. And what's amazing is we'd done a round with them the previous year, and they had raised about 1.34 million, I think it was, in about 4 days. So they were coming back to us now the next year. They had built a waiting list of 5,000 investors who couldn't get in on the round last year, who wanted to invest this year. And, we thought, okay, this round is going to go quick again, but we did not expect that we would open the page at 9 a.m. Eastern time and have to close it 6 hours later because they had already reached their raise target. The success that they had was absolutely incredible. And I think it comes down to a couple things, some that other businesses can look to replicate, others that are perhaps more inherent to Blossom Social itself. I think the one thing with Blossom Social is that they are a social investing platform.
Yes.
Right? So they are a community of investors. So they are 100,000 plus individuals who are either already investors or who are interested in investing. And so when an investment opportunity comes, not in the public markets, but in the private markets, they already have that knowledge built in of how investing works. They understand it, they get it, they're ready to invest. So their audience is just the perfect archetype to invest via equity crowdfunding. Not every company is that, luckily. If you're in the art space or fashion, maybe you're dealing with a community who isn't as familiar with investing, so there might be more education involved, whereas Blossom Social, a lot of these investors already knew that. That being said, the company still did a great job of trying to highlight the nuance between a private opportunity and a public opportunity because they wanted to make sure that was transparent to their community. So in their video and in their campaign page, they're immediately like, hey, this is a high-risk investment. You need to be willing to hold it for at least 3 to 5 years, possibly no more. You cannot sell this right away. They wanted to make sure their community was aware of that distinction. But great audience. I think in terms of other things that companies can look to do, a big one is really just, like I said, building an engaged community, having a great product that your community loves. I think the Blossom Social community and product is loved by their network. I've used the app. It is a great app. And ultimately, they show up for their community shows up for them. That's something that you can't buy. You really have to build organically over time and really build trust with your network. And they've done that exceptionally well. And then in terms of the actual campaign tactics and things like that, I think there are a couple things people can learn as well. One is that they really did build anticipation prior to it starting. So they got investors excited about it before the campaign launched. So they were ready to kind of invest and knew what was coming on day one. And another thing that they did that I really liked is when the campaign launched, Maxwell, the founder, was personally emailing investors to say thank you.
Oh, that's lovely.
After they came through. So
such a personal touch.
Their first round that they did with us, I think he sent out 450 emails the first day, and he attached a little I'm a shareholder graphic, and everyone started resharing that on the Blossom Social app. So it was like the sea of purple everywhere of people saying that they're a shareholder and sharing why they invested. And that really helps get other investors excited about the opportunity as well.
Yeah, this is amazing.
So I think there are so many things that they did well. And also they were just naturally, as a company, well suited for this based on their audience and based on how they've built and nurtured a community over the years.
Yeah, it's interesting that I came across Blossom just because of their crowdfunding round. It was through FrontFundr.
Wow.
That's how I actually came across Blossom and the community, and then I started following them. So it's that flywheel effect, like you mentioned, the community aspects. They use your products. That makes more people know about your products, which is, at the end of the day, a product that doesn't have awareness is there's no path, basically. You need the
Absolutely.
awareness.
And that's where, equity crowdfunding can offer a different benefit than angel and VC investing because, you have that opportunity to build that brand awareness. And it doesn't need to be an either or. It can all work complementary to each other. You can do a round where you have angel funding, VC funding, and equity crowdfunding to be able to really benefit from all the advantages that those different outlets offer.
That's good. That's a good way to frame it. And many people think the US has the biggest opportunity. How does the Canadian deal flow compare to the US? And can Canadians actually invest in US opportunities? Because I know a lot of Canadians. I myself, I try to split markets as well, diversifying basically. So what's your take on that?
Yeah, no, I think, for FrontFundr, we are a Canadian platform that tries to bring Canadian opportunities to Canadian investors. But that being said, we have worked with international opportunities, particularly in markets like the UK and the US that are also quite mature in equity crowdfunding. So we've done what we often call like cross-border listings. And we do many of those with the US. So in particular in the US, companies can raise under something called a Reg A. And then we do what we call in Canada an OM wrapper, where we then can make those opportunities available to retail investors. It's often a little bit easier to go from the US to Canada than Canada to the US.
Oh, interesting.
But we do work with a number of those opportunities. So our first US investment opportunity was in 2020. And we've continued to work with companies since. We do still to this day. So it can be an opportunity for diversification, exposure to other companies. I think generally it's understood that U.S. companies tend to be a little bit bigger, which is often true. So it can be good exposure there. Generally, companies from the U.S. are doing very large raise sizes. They have much bigger advertising budgets than our Canadian companies might. So having exposure to those opportunities can be great. We also do tend to partner with a lot of equity crowdfunding platforms in other jurisdictions. So we've done a partnership with Start Engine where they've got this new initiative over the last year or two where they're bringing later stage private market opportunities to investors in the US. So if you're wanting to invest in really large, like artificial intelligence companies that are staying private longer, which when the markets were down, we were seeing much more of that, that companies were staying private longer. So they'd find ways to package up these opportunities for investors and offer that through their platform. So we partnered with them on a few of those opportunities, bringing them specifically to accredited investors in Canada, but still providing them with exposure that they couldn't have otherwise gotten. These are large companies that you really need to know someone to get into. So still, it's really broadening kind of the reach and awareness of those opportunities for investors as well. So we definitely work with a number of those companies. There are amazing Canadian companies, but just with the US being the market that it is, even a lot of Canadian companies will start here and then they'll look to expand into the US or they'll look for capital in the US. I think in Canada, it's generally kind of understood that, getting the pre-seed and seed rounds are doable, but sometimes there's a lack of lead parties for the follow-on rounds that are much larger. So a lot of companies at that time will go to the US. So generally when we see American companies kind of come to Canada, it is for a larger round size.
Oh, okay. It's interesting. I never knew like American companies actually came to Canada. I thought it was always the other way.
It's an interesting one, but we work with a lot of these platforms and it really just reinforces the message of, hey, doing more of a North American round. And for a lot of these companies who are raising, they're also looking to enter the Canadian market. So it can be a great entry point for them to use those investors as kind of early testing and customers to be able to enter into Canada. Or they may have already had customers here who have wanted to invest, but who haven't been able to because they've only been raising in the US. So now they're able to go, hey, we can now open it up to everyone. We know you've been interested. We're now making this opportunity available in Canada as well.
That's good to know that FrontFundr isn't like limited to Canada because some people like diversification. I personally like diversification. I obviously love supporting Canadian businesses, but there's a part of my portfolio where like putting into like other regions, like other countries.
Yeah, absolutely. And I think companies nowadays are so global, right? They really operate everywhere, particularly with tech companies. So it's, for these American companies to be able to open it up in North America. We've worked with some that have done like tri-continental or tri-country rounds. So we have one right now that's raised in the UK quite a bit and throughout Europe. They're now raising in Canada on our platform and they're raising in the US on Republic. So it's really great to see companies that are able to make the opportunity available in different jurisdictions because they recognize that the opportunity for the business is global and they recognize that they have supporters at a global level. So to be able to do that across multiple platforms that enable that retail investor access is really exciting.
That's good to know. So how do you see the Canadian startup ecosystem compared to the US? Is there a gap? And is it closing? I know there's a gap, definitely, but do you think it's closing?
Yeah, it's a really good question. I think in general, when you look at the US, it's 10x the population size,
Yes.
right? So it's always going to be a bigger market. I think when we're talking like specifically risk capital and early stage funding, we might be looking at a 20x size difference, to be honest, just because Canadian investors and Canadians in general tend to be a little bit more risk averse
Yes.
than investors in the US. It actually is a bit of a cultural distinction between the two regions.
Yes.
So we're not quite at the same level. That being said, I think, we've got great tech hubs. Things are growing quickly. If you look at Toronto, Waterloo, Vancouver, Montreal, like we've got great jurisdictions. We're also, we've got leading universities. We're, global leaders in AI and clean tech and a bunch of other domains. So I think we are starting to close that gap a little bit. We've also seen historically that Canadian companies tend to go public a little bit earlier, but we do have really large private companies now. If you look at Shopify and what they've been able to achieve, it's pretty incredible. So we are starting to see like some Canadian unicorns and things like that, which is pretty incredible. So I do think the gap still exists. I do think we are closing it. We've got great leading universities. We've got great leading technology that we're bringing to market. And I think from an investment perspective, we still need to do some catch up to match what we see in the US, but we are starting to see more of that, I do believe. And I think, equity crowdfunding really provides a great opportunity to get more capital into these businesses to be able to see more growth out of companies as well.
That's good. What emerging trends do you see in this space that funders and founders should be paying attention to?
Yeah, I think ultimately we're finding that funding is becoming more inclusive, community driven, and digitally enabled, which is great. And I think within that there's a number of trends driving this. I know I touched on earlier kind of BlackRock's letter and their call to creating more access and democratization in the private markets. I think we are seeing that recognition from larger players in the space that the private markets are an important area. So I think through that we are going to see, more companies that are raising more opportunities to bring investors into the private markets as well, more innovation there, which is great. If we're looking, at certain trends right now as well, I think the Buy Canadian movement is a big one. When the tariffs first hit, a lot of our companies raising capital were really worried, how would investors respond to this? And I think at the end of the day, you can look at it as, there are some risks for businesses, but also there's never been a better time to support these businesses.
That's true.
So it's a great opportunity to support Canadian founders. And I think that's not really a trend. I think that's going to be a long-term driving impact that we see in wanting to support Canadian where we can. So I think that will continue to be a great trend moving forward. I think we're going to see larger, later stage businesses want to open up rounds to community capital.
That would be good.
Which is quite exciting. We ourselves have seen really for the first time in history, like companies actually hitting the maximum crowdfunding exemption. We had a company, Edison Motors, that launched with us in 2024. They're a clean tech company. They're building the first kind of hybrid work vocational trucks. And they raised $1.5 million from retail investors in less than a week, which was incredible. We've seen the success of Blossom campaigns where they raise in 6 hours. So we're seeing companies do larger rounds in Canada. We're also seeing larger companies come to equity crowdfunding as a form of community capital and raising from their network, which I think is great. So I think we're going to continue to see more of an intertwinement between companies and their communities and really giving co-ownership to all, which is very exciting. And, from the investor standpoint, I think there are just really a lot of great industries that we're seeing growth in. And keeping an eye on those and watching those opportunities and being able to invest in them at an early stage is quite exciting. So definitely encourage investors to, evaluate those opportunities, see those opportunities to participate. And I think we're going to continue to see the private markets grow. The other side to that is the public markets really saw a pretty difficult couple years there. So I think that the public markets are starting to pick up, and generally when the public markets pick up, the private markets pick up. There's more funding in general. So you'll see, I think, more complementary rounds of VC funding as well as equity crowdfunding and things like that, and also possibly more exit events. A lot of companies were staying private longer and holding off because the public markets were so down that I think we'll start to see some more activity there. I think it is Klarna who just did their IPOs. So I think we're going to start to see more of that in the future as well as we go.
I love what FrontFundr is really doing. I'm very passionate about democratizing things and access to opportunities. And I just love how it's allowing everyday people to be able to invest in companies, support founders, support businesses, and also obviously there's the upside of like potential returns, but still supporting those businesses and then getting founders that don't have access to VC funding or founders who don't even want VC funding to go the equity crowdfunding routes. And if someone is listening here, how can they access FrontFundr? Is it an app? How can they access it? And how can they connect with you if they want to connect with you?
No, great question. Yeah. So unfortunately, we don't have an app yet.
Okay.
But you can go to our website, frontfundr.com. Within that, we have obviously our listing page where all the opportunities are. So definitely encourage you to browse those opportunities. I would recommend subscribing to our weekly newsletter as well. Not only do we share all the opportunities and new launches, but we also typically touch on different trends in the investing space and just the business in general. So would encourage investors to check that out. We also have great resources on our platform for understanding this level of investing, FAQs, different support centers. So would certainly encourage investors to review all of that. In terms of myself, you can always catch me on our podcast From Funny to Fame. I interview different founders and experts in the space, so you can learn more about the opportunities available. And I think as we touched on earlier, it's always so great to learn more about the founders of the companies you're investing in. And the podcast is a way for us to dive a little bit deeper into their background and understand their journey a little bit more and get more of that storytelling perspective, which I think is great. And then for myself, definitely encourage you, connect with me on LinkedIn. Certainly available for that. I do post a lot of content, the opportunities, and FrontFundr, we're always out in the world at different events and conferences as well, so you can always come find us there. But great opportunities to learn more about what we do on our website and across our channels. So definitely recommend following us there.
Thanks so much, Trieste, for like breaking down or like contributing towards democratizing the private markets for people and creating that awareness for people. I know people are definitely going to learn a lot from this. At least we shared, or like you shared, the basics that people need to know, and then they have that information to do more research, and at least they just know about it now. There's that awareness, and you can become your own dragon.
Absolutely. And thank you so much for, hosting us on these podcasts. Like we mentioned, awareness and education about this is so important, and opportunities to chat with individuals like yourself and broaden the exposure of that is amazing. So really appreciate all your questions and helping really bringing what we do to the masses. So really appreciate you.
Yeah, thank you. Yeah. And if you're watching on YouTube, don't forget to hit the like button and subscribe. If you're listening on Spotify or Apple Podcasts, give us a follow and 5-star rating. Thank you.